And welcome to episode 10 of The Rent Roll. 10 weeks, 10 episodes. Thank you for all of you who've been listening and watching so far. Been some great traction, great feedback. We're trying to make things better each week. Hopefully you're noticing that, but appreciate y'all making this podcast part of your week. So it's The Rent Roll, and we're talking about all things rental housing. Last week was about the single-family rental REITs, their earnings calls. We had a great conversation with Invitation Homes CEO Dallas Tanner. This week, we'll continue the theme on REITs. We'll be diving into the apartment REITs Q3 earnings call recaps. Obviously, a lot more apartment REITs than there are SFR REITs, but we'll break down top 5 takeaways from the earnings call season. And then we'll have a very special conversation with a former CEO of one of the REITs, Mark Decker, who formerly headed up the Centerspace REIT. And so that's going to be a good conversation, talking to him about the differences between being public and private and what he misses about those old days. So that'll be a good conversation with Mark, so stay with us for that. Before we dive in, as always, I want to give a big shout out to our sponsor, Madera Residential, maderaresidential.com. So check them out. All right, let's get into it. As always, start off with the segment called Here's the Chart. So instead of just regular charts, we're going to be looking at 5 takeaways from the apartment REITs Q3 earnings calls. And I've got some themes that really encompass most of the REITs and what they had to report out of Q3 and heading toward the end of 2024. Number 1, prioritizing occupancy over rent. Now, this may seem like an obvious thing, but it's sometimes misunderstood. The focus is on revenue, not just rent. You want to maximize revenue, not just rent. And so many REITs talked about their longstanding strategies to maximize revenue over rent. And in a high supply environment where new leases are very competitive to win, even in, by the way, many coastal areas, that means cutting new leases to boost occupancy and protect revenue. We're seeing that all over the place. Because remember, vacant unit equals 0 revenue. Now, on the upside, renewal demand remains so strong that renewals continue to grow at a solid, normalized pace of 3 to 5%. Low turnover remains one of the big surprises of 2024. And while move-outs to purchase, the lack of move-outs to purchase is obviously a big factor, you also have to give credit to property managers. Across the industry, we've seen a big focus on quote-unquote heads in beds, and that's really paid off with people choosing to stay put, even if they get a better deal moving elsewhere. Equity Residential was asked about the softer new lease rents on their earnings call, and here's what Mark Parrell said. He said, "This is a give and take process. I mean, we could get new lease rate to be a higher number by letting occupancy decline, and that may not benefit same-store revenue growth, which is our ultimate goal." A lot of other executives made similar comments from other REITs, but it kind of, and really not just REITs. I mean, this is a strategy across the industry. It's revenue, not rent. Particularly in a higher supply environment like what we're seeing right now, I think we're going to continue to see this occupancy focus for quite a bit. And that's why we're seeing a lot of the REITs with occupancy rates still about 95%, even in this high supply environment. Speaking of supply, that takes us to takeaway number 2, is supply peaking. Now, supply is obviously the big revenue headwind in 2024, but REITs across the country are reporting better than expected absorption in Q3. And almost across the board, REITs reported increased optimism about the supply outlook. They're starting to feel like, hey, these completion numbers are leveling off, and while it's still going to be a lot, it's not going to be getting worse. It's going to be a downward trend on supply. Again, I want to make that very clear. Still elevated for supply for the next few quarters, but it's going to be trending downward. Here's a quote from Eric Bolton at MAA. He said, quote, "We are beginning to see early trends with new lease pricing that support our position that the worst of the pressures on pricing from new supply are likely behind us. And as we've been discussing for the past year or so, we are now poised to see moderating trends in the amount of new supply deliveries that are impacting our portfolio as we head into 2025. So again, I think that kind of captures not just the REITs, but the broader view of where we are in the apartment cycle. Strong demand, supply peaking, still supply to deal with, but the market's been pretty resilient considering the 50-year high in supply. Now, all that said, Austin as a market, everyone's been talking about both public and private side. It came up in some of these earnings calls as well. It remains a drag on several of the REIT portfolios, and one that's probably going to take longer to rebound than others. MAA also said, and this is a quote from Clay Holder there, he said, "If you pull out Austin out of both the Q2 and Q3 numbers, we actually would have seen new lease rates from Q2 to Q3 accelerate about 10 basis points as opposed to a 30 basis point decline." So that's pretty interesting. A portfolio the size of MAA's, massive portfolio, and that much sensitivity to Austin. But that just reflects how challenging that market has been for operators of all types. Takeaway number 3, renters are in financially strong shape. Now, those people in the industry, you already know this is true. We've seen this again and again and again, but the headlines don't really capture this. Though, in my view, this remains the greatest underreported story in rental housing, at least for institutional grade market rate apartments and SFR specifically. Across the board, REITs reported renter financial health as an improving tailwind. Rent income ratios are going down as wage growth tops rent growth. We're 21 or 22 straight months of that happening. Bad debt or renter delinquency is going down. Even in the slower to recover markets like Los Angeles and Atlanta, where courts are catching up to the backlogs, operators have tightened up leasing standards and using new technology to detect fraud, and therefore able to bring in paying residents as these long-term non-payers move out. Here's a quote from Sean Breslin at Avalon Bay. He said, quote, rent income ratios have actually declined and are currently about 10% below where they were at the beginning of 2020. So not just, by the way, from the peak of inflation, he's saying since 2020, the beginning of 2020, pre-COVID. And he says, this is important understanding the potential capacity of renters to pay higher rents, all else being equal. So not only is supply coming down, but we're seeing very positive tailwind numbers on affordability, which again supports the rent growth rebound outlook for 26 and 27 in particular. Number 4, fourth takeaway is it time to start building again? All right, so we talked about all this lower supply. It's obviously a very challenging environment to build right now. Starts are coming way down. Just look at the numbers recently. We're going to see starts this year. They're on track to be the lowest since 2013. So the REITs are asking, is it time to start building again? A bunch of REITs actually want to be builders again. Now, before you get too excited and think that this means we're about to see a big resurgence in starts, you got to consider this. The REITs, they have cash, they have access to cheaper capital, that the regional merchant builders who really dominate the apartment construction landscape, they don't have those same benefits. And those merchant builders, regional and local players, like they're the ones who do most of the construction in the apartment space. This is what's very different about single family versus multifamily, much more fragmented and localized in the multifamily space. And so the REITs know this too. And so they see this as a real time to kind of flex that competitive advantage, ramping up construction when others cannot. Now, again, the floodgates are not reopening, but REITs are cautiously optimistic that they can ramp up construction again with hopes to deliver in the lower supplied years of 26 and 27. Avalon Bay said, quote, this is the CEO, he said, we believe there could be an attractive window to further leverage our development capabilities and our cost of capital advantage to capture an outsized share of what's likely to be a lower overall level of starts in the industry. And Avalon Bay just started 4 projects in this last quarter, 2 in North Carolina and 2 in Texas. So both expansion regions for them, since they primarily are still coastal, though they're moving more into the Sun Belt. And by the way, one of those is in Austin. And so there was a good exchange about what they see in Austin at a time when obviously the market is very challenging, but Avalon Bay is a believer in the long-term story there. So similar themes to other REITs as well. So we're going to be really interested to see how this one plays out. Takeaway number 5, our 5th and final takeaway from the Q3 earnings call season. It's a tough time to be an apartment buyer. Nearly everyone, now in the REIT space, obviously they're all looking for similar things, but even in the private market, nearly everyone, I should say, wants to be a buyer of well-located, especially in major Sunbelt markets, newer vintage, Class A, especially recent builds or active lease-ups. But again, it's not just the REITs. A lot of private capital wants the same stuff. So REITs reported that cap rates, because of all this buyer interest, cap rates are falling into the high 4s or even mid 4s. If you remember back to last quarter, the REIT talking about being in the around 5, maybe low 5s. Now we're talking even as low as the mid 4s. And so some are still finding ways to make those deals work, and they're increasingly optimistic that deal flows will accelerate in 2025 as more merchant build lease up stabilize and get positioned for sale. Dan Oberste, the CEO of BSR REIT, he had one of the quotes, one of my favorite quotes on this topic for the quarter. He said, quote, the gazelle that we're hunting right now is a new construction lease up. That's a great quote, the gazelle that we're hunting. And again, a lot of people are hunting the same gazelle. And he said, this is not a direct quote, he said basically, especially suburban Class A, So that's the sweet spot. That's what everyone wants right now. And it's probably going to put more downward pressure on cap rates in that segment of the market. Rick Campo, Camden CEO, he said, quote, "The last few deals we've looked at, you've had multiple buyers and cap rates in the mid fours today, not 5 or 5.5%. And the reason for that is there's more buyers than sellers." And so that was a little subtle dig at how REITs are being valued at a much higher assumed cap rate relative to how deals are actually trading. I'm going to be talking to Mark Decker in our interview today about that very topic. So again, not a lot trading, so more buyers and sellers. That also puts downward pressure on cap rates. But again, there is a view that we should see more trading in 2025 as the pricing has come back up, and more of these merchant builders need to unload and recycle some capital. So there's our 5 takeaways from the earnings call season. We'll do again next quarter, but those are always fun to listen to and read the transcripts from. So hopefully that was of some value. Next up, rental housing trivia. All right. So this week's question, in honor of our guest, Mark Decker, what was the prior name of the apartment REIT now known as Centerspace? So they changed names under Mark's leadership when he was still the CEO there. So what was the prior name of the apartment REIT now known as Centerspace? So give that some thought. We'll answer that in a bit. Next up in the news. This is when we review some headlines and how they impact rental housing. The first one, starting off on a somber note, Bill Freeman, Nashville real estate investor and really one of the kind of founding fathers of the modern apartment landscape in Nashville. He was there, but long before it was cool. Well, Bill just passed away this week at age 73. Bill Freeman was one of the, again, founding father of the modern multifamily in Nashville. From the Tennessean, this is a direct quote. From the article, I should say. He co-founded Freeman Webb in 1979 with Jimmy Webb after the two met at Nashville's Junior Chamber of Commerce. The multifamily real estate and management firm now has over 18,000 rental homes and apartments across Tennessee, Missouri, Mississippi, Kentucky, and Alabama. And more than 9,000 of those rental units are in the Nashville area. So Freeman Webb, big player in the Nashville apartment market, and in large part because of the leadership of Bill Freeman. And so certainly sad to see this news, but his impact will obviously be felt in that market for a long time. Next headline, Charlotte Mecklenburg Schools to share new details about proposed teacher housing shortages. Proposed teacher housing project. Affordable housing project now called At Home and CMS, and for Charlotte Mecklenburg Schools. This is from local TV channel WBTV, excuse me. So Charlotte Mecklenburg Schools, or CMS, they said they want to attract and retain quality teachers by offering them local rental and home ownership options. And soon, I'm reading from the article here, a dedicated housing community. The project was once referred to as Teacher Village, is now called At Home and CMS. In June, the Charlotte City Council approved to give the district $1 million to help study the design process. And there's a quote from a Board of Education member, Monty Witherspoon, saying, we have teacher needs that are very difficult for us to fill. When you look at a solution for individuals who work 2 to 3 jobs and not just grandstanding, we have homeless teachers. And I want people to be aware of that. That's a true statement. And one teacher called the district's mission to provide affordable housing a, quote, blessing. And so CMS hopes to break ground on the project next year. So this is an important story. Obviously, this is Charlotte, but it's true across the country. You know, one of the things that always irks me is I hear people say, we don't need middle-income housing. We only need low-income housing. The truth is, as this story helps really emphasize, it's a both and, not an either or. And this is really the missing middle we talk about. A lot of times these teachers are likely making too much money to qualify for affordable housing in like a low-income housing tax credit property, but they're not wealthy enough to afford any of these brand new apartment units that are getting built, typically at much higher rents due to the cost of construction. So there's a real need for middle-income housing, the preservation and creation of those units. Talked about this in our very first episode with Bob Simpson. And again, this article reaffirms the need for that. So kudos to Charlotte Mecklenburg Schools for this project. I hope it becomes a model for others in the country. Our third and final headline this week is bye-bye broker fee. New York City Council approves bill to eliminate fee for most tenants. All right, so this is a very New York thing. Obviously, we don't really see this in most parts of the country. And by the way, before I get into it, I want to point out that the mayor, as of the time of this recording, has not yet signed this bill. And he said, and he's quoting the articles saying, or the article's quoting, has a comment saying that he has concerns over the consequences for smaller property owners, for tenants who may end up paying more in rent if the landlord factors the broker fee into the monthly cost. So we'll see where this goes. But for those who are not familiar, the way that you rent an apartment in New York is kind of like buying a home anywhere else, where there's a realtor fee, like buying a house. Well, there's a broker fee for leasing an apartment, and that fee is typically paid by the resident. So I'm going to read a little bit from the article. It said in New York's. It said in New York City, unlike every other place in the country, almost every other place, tenants are often forced to fork over a fee on top of their rent to a broker hired by a landlord before signing their new lease. This happens even to tenants who have never met the brokers. The fees typically equal about 15% of the yearly rent, which is $6,300 for a $3,500 per month apartment, and go to the broker who listed or showed the unit. But the bill approved by the council would upend the dynamic by requiring the party that hires the broker, usually the landlord or building manager, to pay the broker's fee. Tenants who hire a broker for assistance will still be responsible for their fee. The council voted 42-8 in favor of the measure. One council member said, "This bill is common sense. It replicates how every other transaction exists in the country. Whatever you hire or order, you pay for." Another one said, though, "These fees aren't going anywhere. They're just going to be built into the rents, and rents will go up as a result." So we'll see where this goes. But ultimately, at the end of the day, I mean, in a low supply environment like New York, I mean, let's just be honest. Like the property owners have no incentive to absorb these costs. They're going to get passed down. The only way really around this is to expedite online leasing capabilities and whatnot, virtual tours and in-person tours, self-guided. That would get you around the broker requirement. But it's a very different market in the rest of the country. When you have walk-up buildings, they don't have central management on site or on-site property management. They do have centralized management somewhere else. Like that really changes the touring and leasing model. And that's why the broker model has lasted as long as it has in New York. So we'll see where this goes. But in the day, we shouldn't be kidding ourselves. There'll be some big savings to renters. It may distribute that cost about the term of the lease as opposed to paying it up front. That alone could be a big benefit, but it's eventually could probably get passed down in most cases. All right, next segment, new digs. So this is when we highlight some construction. We highlight a recent project that's either under construction or was recently built. And this one is featuring, or I should say, is in honor of last week's guest on the podcast, Dallas Tanner, CEO of Invitation Homes. So this one's called Old Hickory. It's a build-to-rent community just outside of Orlando in the town of St. Cloud. What I really like about these BTR communities is they have something that nearly every new apartment community does not have, which is pictured in this. For those of you who can see the video, it's a playground. Every little kid needs access to a nearby playground, and it's a pretty unique looking one too, made out of wood here. So Old Hickory has detached homes with 3, 4, and 5 bedroom floor plans. Next up, good question. This is when we address a question that comes from the audience and from social media. This week's question is, what types of apartment projects will come back first, urban infill or suburban garden? Saw this question up recently. That was a good one. And just where we are with construction costs today, the big focus is on getting those costs as low as possible. And so these deals could pencil out with a higher cost of debt and construction and everything else. And so that's really going to put more focus on garden construction for the time being over urban, especially the higher rise projects. Now let's return to rental housing trivia. The question this week was, what was the prior name of the apartment REIT now known as Centerspace? And the answer is IRET, Investors Real Estate Trust. So there you go. You got your rental housing trivia of the week. And that's going to get us right into the conversation we have with the former CEO of Centerspace, Mark Decker. He's also the founding partner of Proterra Real Estate Partners. So I'll be talking to him about that transition from public into private. Hope you enjoy this discussion here with Mark. All right, now welcome back. We have the interview portion of today's podcast, and I'm thrilled to welcome in person, Mark Decker, the former CEO of Centerspace and now managing partner at Proterra Real Estate Partners. So thank you so much for being here.
Yeah, thanks for having me.
You made the trip into town, and you came from Minneapolis, right?
Yeah, it's a little warmer here and a little sunnier. It feels good. Yeah. Good to be in Dallas.
Yep, definitely a little bit sunnier here, I'm sure. So let's start off just about the industry and how you got into it. So you had an interesting kind of way into multifamily. You started in banking before moving on to run a pretty sizable REIT, Centerspace. So I'm curious to ask, moving from the sidelines into the playing field, what was the biggest surprise you had or something that changed your perception of the industry now that you were in it?
Yeah, so I mean, I guess it's not a super unusual path. I was a finance person and I got put into a role. Originally, we had a activist short seller. So Jonathan Litt, who's a well-known activist in the space, had written a short report, and that's really how I ended up there at what was at Centerspace, which was then called IRET. And I would say the biggest kind of surprise, having spent 20 years in the public capital markets, and I mean, I'm a huge fan and advocate of the public market. But in 2016, there was a pretty big kind of sea change, and that was really kind of twofold. The first was REITs got their own SIC code. So they used to be part of the financials. And so you could hide and not out. You could just buy more JP Morgan and not own REITs and kind of still stay allocated to REITs. Or you could be very actively involved, and there were investors doing both. And that was a pretty big change for the folks who run the money, the so-called REIT mafia, which if you went and looked at, say, Simon Properties or Avalon Bay's 2008 shareholder register, the top 20 owners, many of which would be smart, thoughtful real estate securities people who knew the business, understood, could ask good questions, cared quarter to quarter, kind of made a market in their own mind about what was rich or expensive. And in 2016, in part because of the SIC change and really in part because of the continued march of indexation, that changed. So if you looked at that same shareholder register, it would be mostly robots. So there were less focused people in the names, which harmed us. I mean, when I got there, we were really looking to change some of the things around the business. And I'd say darkness was good then. We could sort of move under the cover of nobody really cared about us because we were a small cap or micro cap. But then as we really turned it into a multi-business, and in my opinion, we would have said, or they would say, I think that was kind of 2018. We did some really good things. We started, just for a little bit of perspective, it was about a $2.25 billion balance sheet, half of which roughly was apartments. Of those apartments, 12,000 of them were in 12,000 apartments. 40% of our NOI came from North Dakota. We had a decent sized position in the Bakken, which was not going well. That was kind of the bottom of the oil market. And we had a lot of inefficiencies from an operating perspective. The business had been run as a diversified pool. So we didn't have kind of black belts in operations. We had great people and people who cared a lot about it, but we just, we had the phenomena of that business was working better than some of the other property types we owned. So it wasn't getting as much love and attention. And then as you sort of peeled those things away, we had relatively inefficient communities. We had 125 to 130 apartments per community, which is, there'd only be one, I think, of the publicly traded REITs besides Centerspace. It's currently probably below 300 per community. So you're just like de facto less efficient. And we had some markets that we didn't love. So it was really about rearranging all that. And when we got there in 2018, and really had some really, I think, good results in terms of consistent cash flow growth and a improved balance sheet, nobody cared. And I mean, my parents were proud of me, and it was exhilarating. I mean, we have an awesome team, and it was super fun, and I think our shareholders valued it.
Absolutely.
But we just, in my mind, in theory, in financial theory, you would get the most credit for something that's more consistent and public. And unfortunately, that's not the way it works. I think all the multifamily companies are currently cheap relative to their hard asset, their main street value. And you could do that. I mean, just to stay on Centerspace, I think they're worth roughly $2.3 billion today, and it's almost 13,000 apartments. So that's like 180 a door. So if you ask anyone who knows anything about construction, if they could build
they can't.
13,000 apartments for $2.3 billion and fill them for that price? The answer is most assuredly no. But that's the way it is. And MAA and others, same story. You had Dan Oberstein here. That's a great company that's not properly valued. But anyway.
Well, I want to come back to the valuation topic. That's a good one.
Yeah, sorry. I'm not sure I answered your question.
No. You think you're hitting on a sore spot for every one of your former peers.
Yeah. Well, I have lots of empathy for them.
So, let's just jump to that. We'll bounce around here a little bit. So what you're alluding to is right now we're seeing a lot of these heavily traded apartment REITs. Their stock prices are discounted relative to the net asset value. If you look at just what's trading today, the cap rates. So, do you? I guess the answer is yes. But do you buy into their gripes? And where do you think they should be trading at?
Yeah. It would stand to reason that if you could. To me, let's use MAA, which is one of the larger companies that's in the Southeast, and I think one of the best run companies with an incredibly enviable track record of very consistent earnings growth over a very long period. So the way we always thought about it was who's grown the most consistently. It's simple valuation kind of math, and they would win that prize. It's a long track record, 20 plus years. They've got an incredible balance sheet. Yeah. They've been active operators, active managers of the portfolio.
Great team there.
So I can't think of something bad to say. They might be under-levered, if that's a complaint. But if you look at that business, it should trade for what you're basically getting an A balance sheet and an A plus management team for free, and the assets at a discount. So that's how I would think about it. And so to me, a lot of investments are, sold, not bought. And if you look at the public markets, I think it'd be very hard to argue that they don't have the best alignment. And you could make agency you could pick at some of the things, this guy makes too much money or whatever. But in lots of country club deals, you pass the hat for a apartment deal. I can tell you the guy who put the deal together probably made money the minute they closed.
Yeah.
And that's okay if you are sophisticated and know what you're doing, but it's not as well aligned. And you're absolutely paying at least the cost of the building.
Yeah.
So right now you can buy 100,000 Southeast apartments run by stone cold killers with an A plus balance sheet at a discount to what it's worth, or you can give your friend money and he's going to go build something or buy something at exactly what it costs to build it, or maybe some discount. But if you just look at where the friction is, the public markets are so efficient. Now I've moved to the private side, so I guess I am they in this example. But I think it's all about alignment and expectations and having a sophisticated investor. If you just want exposure to apartments, I don't think there's a better way than the public markets.
Yeah, and just as I don't want to pick on anybody, but I'll tell you, I remember earlier this year reading one of an analyst reports that was building, in this case, I think it was Camden, where the assumption was a 6 cap on their value to build up what they considered what they estimated for net asset value. And even at the time, nothing was trading at Camden quality or any REIT quality levels at that. So I want to ask you, I don't want to pick on anybody. I know there's a lot of great folks in this industry that are friends of ours, but just as broadly speaking, when you were CEO at Centerspace, were there common misunderstandings among the Wall Street analysts, or maybe something that they tended to not focus on correctly?
Honestly, I think the analyst community, there's bright spots and less bright spots, but they all work really hard. They're trying to generate incremental return for their customers. So, and they're an essential tool. They're out there doing some of the work that it would be hard for an issuer to do. I think it's really more about sort of the setup of the investment management market. So, as I told you, one of my colleagues is John Miner, who was at Heitman.
Yeah.
If you put someone in a chair like that, they're running, pick your professional manager, they're running a $5 billion securities portfolio, and you look at a company like Centerspace, just to stay on them, you don't have to actually have an opinion of Centerspace. The market cap of the whole multi-space today is plus or minus $150 billion, and they're less than 2. So, they're getting ranked every day against their competitors and against the index. And so really they have to have a point of view on the larger names and they're over or under. Yeah. And if someone really rips, they lose performance. So it's really a tough chair for them to be in. And there just aren't a lot of good fundamental long-term investors who can say, like, I don't really care what happened today. Like, I'm fundamentally long these names. I mean, there's a handful of them, but it's just, I think it's less about the analysts and more about the kind of setup on the buy side.
Yeah.
And part of that is part of it was the SIC stuff, and part of it's indexation. Part of it is how much easier the private markets are. So obviously the big sponsors have made a lot of headway in the non-traded REIT space, which they've made a better product than what was probably there before. And there's also all sorts of things that regular way private sponsors can do that they couldn't have done 10 years ago in terms of, number of investors and disclosures and things like that. So, the capital markets are just much more robust, and that's good on balance. But it is just sort of perverse that the more liquid, most transparent thing actually trades at a discount, and the least liquid thing trades at a rack price that is higher.
Yeah, and obviously can't pin all that on them. But I just, for me, I was not in the same position as you, and I'm still not. But I always found that, again, speaking very broadly, there's always exceptions. It seemed like there was misunderstanding of the Sun Belt and the Midwest. And the Sun Belt, and I want to talk about specifically like pre-2023, it was more about who are the leaderboards on supply as opposed to looking at supply and demand together and seeing for a decade, these markets are outperforming because there wasn't as much supply as there was demand. And then the Midwest, it was just kind of, I think, and obviously you experienced this as really the only major REIT that was that located the IRT a little bit, mostly you guys. The strength and the resiliency, the consistency, the steady Eddie nature of those markets, they're not quite as sexy and attractive, but there is a great story there. So to me, I think it's always been a little frustrating. I think just the not understanding the strength of the interior U.S. markets.
Yeah, well, I mean, I was a history major, so I think there are some roots in the history of that. And if you go way back to kind of the go REIT or go broke era of just post RTC in the early 90s, the best public company in the apartment space was Avalon Bay. Mm-hmm. Lots of people got into the public market because it was better than going bankrupt. I think Avalon Bay, probably more than anyone else, got into the market and thought, what does it mean to be public? How do we do this well? And they started doing it. And they were way ahead of they were at least 10 years ahead of most of their peers, in my opinion. And I was around then. And Dick Michaud and his team said, what are the things that the guys at Fidelity want to hear about? And they started doing it. And they had a high barrier bias because they were developers and very good ones. And they still are. But they kind of led the charge. And then Scott Sellers came in. I mean, he was quite a Pied Piper of, what mattered. And at the same time, you had companies like Associated that weren't great operators and weren't experiencing, there was a lot of really good urbanization happening in that time period.
Yeah.
So it isn't the fact that high barrier markets are just better, but it is the fact that they were experiencing some great growth when, Ohio wasn't in 2000 to 2006. And so some of that legacy just kind of permeates. And, the fact of the matter is a bunch of those guys bought a ton of stuff. EQR bought a ton of stuff. Aimco. I mean, I think Aimco over 300,000 apartments, EQR all over the place. And that sort of like Invitation, they made a great value play. They bought a thing really well, and then the market kind of grew up around them, and Avalon Bay had a pretty strong premium. Yeah. And I think if you see someone who has a premium like that, they go, well, what are they doing? And what they were doing was growing their earnings more and more consistently, and they had that kind of built-in vig in the development to stabilize spread, which that's hard to replicate. But we can go replicate some of the markets, and I think that's some of the heritage and legacy. I haven't made a study of it, but those are facts. Those were, if you looked at Avalon Bay's multiple in 2004 versus everyone else, it was a couple turns higher, and then it kind of went away. John Kim at BMO actually did an interesting analysis of this 5 years ago. Avalon Bay actually lost multiple from 2005 to 2017, and everyone else kind of gained it using the same playbook. We're going to be less levered. We're going to be in more high barrier markets. So, nobody liked MAA in 2009. I can remember talking to Simon Wadsworth. He's like, look, no one called us about buying this company. And I mean, that sounds absurd right now, but they were a really good operator, and I think they were happy. Like, no, don't tell anyone. Greensboro is fine. It's terrible. Don't come here.
And I think a lot of times the public markets like to make it about Sunbelt versus coastal as opposed to kind of a both and. And now you're seeing even like, you mentioned Avalon Bay, they've obviously started to move more into the Sunbelt, not completely, but they're trying to diversify EQR the same way. And I think that's the hard part about it. It's not so much an either or, but you look at, I think you mentioned the GFC period prior to 2008. I think what my personal view, and tell me if you disagree, it's like, I think the public markets were slower to see what private capital saw, which was the maturation of these Sunbelt markets and the changing demographics, where all of a sudden these weren't, we saw high income jobs and young adults and prime apartment renting age who were moving to places like Dallas and Houston and Austin and Nashville and Charlotte and Raleigh and et cetera. And I think the strength of that, especially over this last 10, 12 years, obviously the market, you said MAA and others, they've come to realize that, but I think they came after some of the private institutional capital kind of paved the way.
Yeah, and I think there's definitely truth to that, and I think some of that is the kind of business strategy that they were running, and some of that is the capital market. I mean, those two hands kind of wash each other. If you are getting a premium cost of capital, you probably want to keep doing it. But I think there's some truth to that, and there's also obviously been a lot of consolidation. I mean, when I started in the business, there were 28 REITs that would cover apartments. Most of them got taken private or are in other portfolios that are public today.
And by the way, I want everybody to know who's listening to this. I'm not knocking on the coastal markets thing, especially you mentioned Avalon Bay. They've done such a good job targeting suburban, high barrier to entry areas that are high barrier to entry, but also are more friendly operating environments as opposed to some of the cities where it's been more challenging. And the Midwest, I'll tell you too, is like, I think what the REITs haven't yet moved to as much is what we are seeing on the private institutional side is we're seeing the private guys are looking at places like Columbus and Kansas City, Indianapolis, and these aren't really REIT markets today, but I think they might be down the road.
Yeah. When I got the job at Centerspace in 2016, I called Dick Michaud, who's a friend and a mentor and an awesome apartment investor, and said, "Hey, what should I do? Dog catches car." But one of the things he talked about was that they had been in Minneapolis and they had left because they thought it was too small. They couldn't build scale there. So I mean, a lot of these companies, it's kind of back to the future. EQR was in all these markets. Yeah. And we talked about Aimco and Avalon Bay to some extent, and others. But I do think you have to create earnings growth, or you kind of don't get to stay in the game there. And that's part of why they're going there. I mean, they're coming to Dallas because there's earnings growth here. Yeah. And they do have, in some instances, a real cost of capital advantage. Right now, I think it's less so. But if you went back kind of pre the big rate spike, being an unsecured borrower is a meaningful advantage. I mean, borrowing 10-year IO money, where some of those companies are able to borrow it, is something that most private folks can't do. Yeah. So that's kind of gone away a little bit. The agencies are a great equalizer. I can almost borrow money at the same price Avalon Bay can right now. That makes no sense, but that is the fact.
Well, but they may have an advantage now on the development side, being able to build off their balance sheet as opposed to having to get expensive construction.
For sure, no doubt.
Yeah. All right, let's talk about kind of your post Centerspace time. You left last year, right?
Yeah, about a year and a half ago.
So it's been a little time. You went on to start, to partner with some friends and colleagues from Proterra and build out a real estate group, as I understand. So tell us a little about this new venture you're in and what led you to step out of the REIT world into kind of the dark side here, the privately held investments.
Well, my wife would tell you it was a bout of insanity, but honestly, the work of kind of changing Centerspace into what it is, which again was a huge team effort that I'm super proud of, was really exhilarating. Mm-hmm. And then we were kind of there, and it's a well-running company. And I couldn't be Eric Bolton. I mean, his sort of constitutional equanimity is not mine. And I was it could be boring in times. Yeah. To just run, and I mean that is a super skill, and there are people who are great at it. I'm probably not that guy. So I'm probably a little bit certainly ADD, and I wanted to do more and different stuff. I mean, when I was an investment banker, I think I worked with over 100 companies that we actually did stuff with, and there's hundreds of other companies who wouldn't hire me that we spent time with. So you really get a lot of, it's very intellectually stimulating because you're learning about different businesses, and you can play in much different markets. I mean, we really had, if we were going to go we were in 2 NFL markets, so to speak, Denver and Minneapolis. And frankly, the buy side hates Minneapolis for reasons I don't understand, but and actually a lot of the research community, like, I almost think they make an effort to not say things nice, and they do say things bad. Like, oh, Minneapolis has a bad stat there, get it on the list. What's happening in, Orange County?
St. Paul didn't help either. So,
that's terrible. I mean, terrible policy. I don't know if we want to talk about that, but yeah,
I think everybody knows at this point. So
that was a terrible idea. But so it was really about kind of casting that a little wider and looking at different things. I actually wasn't a multifamily professional by background. I actually didn't spend a ton of time banking multifamily companies. So, the imposter syndrome was a little bit real. I mean, I love the business. I love the people part of it.
Yeah.
It's so cool to be, building communities for people and making homes. But I just wanted to do more and different stuff.
Yeah.
And my colleagues at Proterra is about a $4 billion asset management firm that got its roots in Cargill, which is a large food and ag company, one of the largest private companies in the world. And the business there is really, we have a couple different interesting lines of business. We have a vertically integrated farm business where we own farms in Brazil and Australia. We have a Asian growth equity business around food. We have a credit business in the US that's focused on kind of full stack or unitranche lending to cash flowing food companies. We have a venture fund that's doing growth investing. So, I'm sort of like the guy on Sesame Street that doesn't fit, but I think from their perspective, when we left Cargill's, left their shield, so to speak, we could be in North America. We couldn't prior to that. And I obviously wasn't there then, but, we're trying to build an interesting business. And, so the last year and a half has really been about trying to come up with ideas that deserve capital and where we think we can actually make people money and deserve to ask for their capital. So we're getting close on a bunch of that stuff, but it's been really interesting, a year and a half.
So let me ask you this. Most of us, for me and probably a lot of people watching this and listening, are almost fully focused on the rental housing space or at least commercial real estate. Now you're in a position where you're looking at a lot of different alternative asset types. And so with the broader, food production, agriculture, all these things you mentioned, that broader lens you have now, how do you think multifamily, SFR, how do you think rental housing stacks up for the longer term against other alternative assets?
Yeah, I love the housing business. I a few partners and I own some apartment business. I still own my Centerspace stock, and I own some other public apartment stocks. But so I'm a big believer in housing. It's unless we get to the matrix, we can't ship that anywhere else. And I do think the home's really becoming more of people are spending more time at home because of how they're choosing to work. And I don't know how that'll all sort out, but I think on balance, people will spend more time at home next year than they did in 2015. And that inures to the benefit of the housing providers. I would say as an investor, having looked at a lot of deals as a potential buyer, it's tight. There's a lot of capital that likes multi. You do have, the government in there with Fannie and Freddie, and it'll be interesting to see how that changes. I don't think it'll change materially because I think the government needs to have a piece in housing. That's their belief. I think that's probably fair. How easily they can inject themselves. They're way injected now. Maybe that scales back. I don't know. But when I look at sort of unlevered and levered returns for multi today, they're not as good as some of the other alternatives. And I really do think that the sort of three horsemen of regulations, insurance, and taxes. If you're in a major metro, the cities are going to face a loss of tax revenue because their commercial real estate is going to go down. There's all sorts of bad ideas in a lot of these legislations around where they're going to get that money, and specifically housing policies, and that kind of keep housing from being built. And then insurance, I think, is a big problem because in my time, I want to say we were compounded high teens, and that understates how bad it was because the thing we were buying in the beginning versus the thing we were buying in the end in terms of coverage and riders and deductibles is so much different and worse from a financial perspective. So more risk to us for more money, a lot more money. And so those are headwinds that I don't think are going away. I also think a lot of people in the housing business put on some great 5 and 10 year debt over the last 5 and 10 years, and that's going to be rolling. So that's a real earnings and equity value headwind, which could be opportunity if you're a buyer. But anyway, so I like the business, but I think it's not, we're not spending our energy there right now.
Yeah. So maybe long term, still like it. Short term, you're seeing some
There's other more interesting stuff. I mean, so that's where we're spending our time.
One last question for you. Now that you've gone from running a publicly traded REIT to now being a privately held asset management company, what's the biggest difference in the public world versus the private world?
I do think the buy side can be very narrow-minded about how, like if you went into a large private equity firm and said, oh, you can't look at anything in Dallas because you only own things in Denver and Minnie, they'd be like, that's ridiculous. Of course we can. But in the public markets, they sort of have that, like, ooh, yeah, I don't know if you can do that. Like, I bet I could. But then they get a say, and you've told them what you want to do. So there's, I'll say, some fairness there. But I just think it's, it's a much less steady paycheck, I'll say that. But it's also just much more opportunity to be creative.
Yeah.
And I mean, obviously you have to kind of earn that by generating people returns. But I do like the sort of the flexibility and creativity that you can employ, which I think in other spaces, people do. I mean, if you look at like a company like MicroStrategy, this guy's buying Bitcoin. It's a software company.
Yeah.
And he has like a $30 billion Bitcoin portfolio. That's probably the extreme. But I'd say generally the heritage of the REIT market, it's pretty buttoned down, and people have very finite expectations. And that's a little bit limiting. I mean, the buy side in my mind sort of like created their own problem because they were not supporting smaller companies. I mean, like Dan Oversee talked about how they couldn't have gotten public in the US market. He's absolutely right. There was no shot that was going to happen. And I think that's kind of a bummer. And I understand why, for the reasons we talked about. I mean, that company would not have been relevant to the overall, iShares index. But you do want selection, and you want kind of that Darwinian thing of companies trying to make it and making it. And I do think much less interesting, less profitable companies in other spaces work public. And the real estate, because it's kind of hard finance. I mean, it's contractual rent. So you have a big G&A, you have a big cost being public, and it's a pretty big barrier. And then when you get there, it's a get rich slow business. I mean, and that's like, should I buy Avalon Bay or NVIDIA? Like, I don't know. If you made the Avalon Bay trade, like it might feel great, but boy, your account's not as valuable. And, that's just, you require that kind of investor.
Yeah, I'm guessing you surely don't miss the quarterly earnings call seasons. So.
Yeah, I mean, I never begrudge them. I mean, it's one of the times you kind of get 4 times a year where you can talk to your investors. And I mean, ultimately, in my job, that's who I worked for. And so that part, talking to our investors was invigorating. The fact that of our top 20 investors, only a few of them could actually answer the phone and have a real opinion on our business, that was frustrating.
Yeah.
And that's, if you were a larger cap, you would have less of that than we had.
Yeah. Well, Mark, thanks so much for making the trip. Appreciate having the podcast. It's been a lot of fun talking with you.
Yeah, likewise. Thanks so much for having me. I appreciate it.
All right, big thanks again to Mark for joining. He was gracious enough not only to participate, but actually to fly down to Dallas and join in our studio. Really enjoyed hanging out with Mark, and hope you all enjoyed his insights from kind of the unique position of now being in recovery as a former CEO of a publicly traded REIT. Quick plug, next week we'll be releasing earlier in the week. It'll be coming out on Tuesday with episode 11. Obviously, we have Thanksgiving next week, so coming out early. And I've got a great conversation coming up with Alicia Hill, who heads up impact investing for FCP. We talk about the institutional buy box for affordable housing and how it's evolved. She is one of the real gurus in this space, so I know you'll enjoy her insights. So please join us again next week for episode 11. Until then, that's a wrap for episode 10. Thank you for making us part of your day.